Stocks volatile but higher this morning after initially dipping as the hot payrolls report complicates the labor market story. We got JOLTS data earlier in the week that suggested the market may be decelerating. This morning's report showing unemployment has ticked down and that wage growth number remaining high. I want to bring in Matt Miskin, John Hancock Investment Management Co-Chief Investment Strategist. So Matt, as you're trying to make sense of the numbers that we're seeing here, how does this bode for markets?
I think right now it's not as soft of a landing as it was earlier today. It's amazing how widely interpreted this soft landing scenario is. But what we're seeing is the jobs market has been the foundation of the U.S. economy, the strongest pillar, and it continues to be so. It just feels like a never-ending late cycle environment where the economy continues to push along here from the employment picture. But what you saw over the course of the day is the dollar has actually strengthened a bit. The 10-year Treasury yield has risen, and the 2-year yield has also risen, as you touched on earlier. And so that's actually placing a bit less of a rate cut / pivot party types push in the markets right now. So some of those early gains were faded, but in our view, right now, it doesn't really change much. We think the Fed is going to be on hold. We think the market's going to be choppy here after a huge run. And for now, we're just being patient.
Indeed. I mean, it looks like the Fed can afford to at least let the medicine continue to take hold as it works its way through the real economy. But even as we look at year-to-date performance for the S&P 500 and the NASDAQ, still up 20% and 37% respectively. But you say it's not about the sort of the earnings boost, because the earnings growth story didn't really seem to happen this quarter.
Yeah, what we're seeing is a lot of multiple expansion. So the forward PE on the S&P 500 was about 16 to 17 times. We're now more at 18 to 19 times. At the beginning of the year, there were a lot of bears and everyone was predicting a recession. Now there's a lot of bulls and there's very little recession calls. So we've seen a pretty significant sentiment shift. To us, sentiment is a very difficult thing to actually position for. If you want to be a contrarian and be bullish when everyone's bearish, you would have actually done well this year. But now the question is, now that everyone's bullish, are you peeling back some of that risk? In our view, we want to focus on the fundamentals. We're overweight quality on the equity market. We're overweight the U.S., but we are looking to trim some risk here after such a huge run in November.
And so then, is the next story going to be about small caps versus the Magnificent Seven as we head into 2024?
It's just the whole destiny of the market is really driven from those Mag 7, the top stocks. And we do think that's going to make it harder into next year. Tech is up 50% this year. Going into next year, it's going to be hard to replicate that. And it's the biggest sector, almost 30% of the S&P. We do think there is going to be a rotation on a relative basis. But at top level, it's just going to be hard to get much more return potential after such a massive remove in some of these top stocks. So we are positioning for cheaper valuation stocks down in cap, but we got to make sure they're profitable. There's about 40 to 50% of the small cap space that's not profitable. If it's profitable, trading a decent valuation, that sounds like a good opportunity for us on a relative basis into 2024.
And then as we look at the expectations, obviously some of the wind coming out of the sails on either the pace or the depth of the rate cuts potentially that at least markets were expecting. In your note, you say stocks are stories, bonds are math. Walk us through that.
Yeah, so I mean, the stock market this year, again, a lot of it's just a sentiment shift from bearish to bullish and multiple expansion. And a lot of it's the AI trade. I mean, you take out the AI kind of market performance this year, which is a lot of it based on future growth that may or may not materialize. I think this market it's more like a 10% return instead of 20% return. The bond market is math, and what we do have is higher yields than when we started the year. We're looking at high quality bond yields between 5 to 6%. To us, mathematically, and they're trading at a discount about 90 cents on the dollar in terms of where they're trading relative to par. That math looks a little more attractive to us than the equity market trading at a high multiple, looking for a high earnings estimates. But we're going to have to see into next year. We think actually bonds can be really competitive for stocks in 2024.
Certainly a theme that we continue to see. Appreciate you taking the time to join us this morning. Matt Miskin, John Hancock Investment Management Co-Chief Investment Strategist. Thank you so much.